services inflation and as well as the whole basket during 2024, as expected and kind of smoothly. We thought there would be bumps, there were, and there will be in 2025, and we'd already forecast that in November. We also got the agents' pay survey coming in at 3.7 for 2025. That's the expected wage growth this year, which is substantially lower than the figure around 6 that we had last year. So wage inflation is expected to trend down towards what is probably the ultimate sustainable long-run level around 3-ish. So those are the positive notes. The more cautionary notes were a bump in our inflation forecast, not due to supply and demand pressures fundamentally, but due to one-time tax and administered price increases. Most importantly, the off-gem price moving, contributing plus 0.4 to inflation. We also had a big increase in water prices because there's a front-loaded increase in the off-watt tariff. There's bus fares and VAT and so forth. Now, normally you would look through those kinds of one-time shocks and you would say that's a shift in the price level and not an indication of fundamental inflationary pressure in terms of a trend. And of course, if it was one of those shocks, a 0.1 here or a 0.2 there, you'd be quite relaxed about looking through it. But when it's 5 or 6 of them, a 0.1, a 0.2, a 0.3, and they're adding up to 1, you feel a little bit more cautious about looking through all of them at the same time. You maybe have some concerns about, is that going to feed through into inflation expectations? Where will it take us next? So that was note of concern 1. Note of concern 2, private pay growth in the AWE from the ONS. That had been falling smoothly throughout 2024, but in the final months, it made an unusual U-turn. It looked odd to me. It didn't line up with our other indicators that we use in the bank, and it influenced my thinking. So new data points may come along. Possibly the past data will be revised, but until we get that, it's hard to get a clear signal on the direction of travel of wage growth. So summing up, those 4 pieces of evidence were in my scales. I saw both upside and downside risks, but I weighed them up kind of evenly and thought we can stay on this gradual path. I saw no strong reason to hold, no one else did, and I saw no strong reason to go for 50. So summing up, I did strongly argue for the use of the words gradual and careful in the statement, which is my way of saying, kind of along with the middle of the committee, the median voter, that I see the risks as being two-sided because of this uncertainty that has widened. Whereas the word or adjective cautious might be more associated with one-sided risk. So I thought it was important to put that in the statement as a form of communication, and of course that uncertainty has only widened from November up until the February vote, and then from the February vote up until now. Even in the last 3 or 4 days, it's widened considerably. So therefore, I think we do need to be attentive to all signals going forward. And as far as I can see, every meeting coming up for the MPC will be a live meeting, because I think that's the nature of things when you're making policy in a time of extreme uncertainty.
It was really comprehensive and helpful. And when you made this very interesting speech in January, and we were interested to hear what you had said last time, and in that speech, though, you weighted the probabilities of the 3 cases at 40% for the dovish case, 40% for the central case, and 20% for the hawkish case. Would you like to confirm those numbers? And it would be helpful when others answer if they could give their weighting on those cases as well.
I think, we'll probably talk about this some more as we go on, but there are so many shocks happening right now that I don't think I would move my central distribution much from that. I would just say
it would be odd if it moved massively from January.
My certainty about any of those numbers has gone down significantly.
Okay, thank you. Megan Green, keen to hear from you.
Yeah, thank you. I guess my main message is that I think that the disinflationary trend that we have had is broadly on track, even though we have this near-term increase in inflation in our forecast. And also that you mentioned the 3 cases, I think we continue to be in a case 2 state of the world, which involves an output gap opening up to bear on inflation persistence and squeeze it out of the economy. And so those 2 things really motivated my vote to remove some restrictiveness at our last meeting. But to my mind, the risks have shifted a bit since we started this rate cutting cycle in August. As you've noticed, GDP has roughly flatlined since March, and how that affects your policy views really depends on how much you ascribe that to supply versus demand. And I think there are reasons to think that actually it's probably both. As Alan mentioned, in our forecast treatment, we've put a lot of that into supply. I'm actually worried it's even more in supply than what we have in our forecast. I think there is a narrative that makes sense that suggests that policy uncertainty domestically and globally, higher taxes, might have weighed on demand over the past couple of months. My problem with that narrative is that, as Alan mentioned, we've seen AWE, private sector regular wages, take up. They're volatile, but actually our own indicator-based measure for wages also has ticked up, and all other indicators are pretty high still. We've also seen some domestic cost pressures increase, particularly for food and core goods inflation, and that's what I would expect to see if there were a supply constraint in the economy as well. So I'm a bit concerned that there's a supply constraint now, and also that looking out through our forecast period, we expect supply to recover, and I think there's a risk that it won't, productivity growth and potential growth therefore might not recover as we're expecting. So to my mind, I said that I think the balance of risks have shifted since we started this rate cutting cycle. I think given the supply constraints, the risks have shifted away from a case one state of the world where external shocks kind of unwind on their own and inflation comes down, towards a case two or case three state of the world, where actually it will require monetary policy to continue to bear down on inflation persistence.
Just from the two of you, lots that we're going to be probing later, particularly about some of the global shocks. Governor Andrew Bailey.
Well, thanks, Chair. I mean, Alan and Megan have put it very well, actually. But I'll just pick out a few things. So my decision to vote for a cut was grounded in the underlying disinflation story still holding with, and this is why we use the word gradual. I mean, the gradual, in a sense, erosion of the persistent element of inflation from the shock sort of we had sort of 2-3 years ago now, but more than that, is continuing, and that's probably best illustrated by looking at core services inflation, which actually came down in the latest number. And I say that because that's one of the better measures of sort of what I call the sort of underlying balance of activity in the economy. So that's the grounding for the decision to vote for a cut. Now, as Alan said, we are, to state I'm afraid the sort of blindingly obvious, living in a world of even greater uncertainty than we were probably last time we were here, and I want to come on to that. I'm rather more in the case two with sort of balance on either side than probably Megan is, but that's reasonable. People can take those views quite reasonably. And then there are four things I would pick out, and I will only talk about them very briefly because I'm guessing we'll come back to them. First of all, this question about activity and the fact that we've had very flat activity really since last spring. And the question that Megan's just talked about, which is it supply or is it demand? And I think two things there. One is, it's actually quite hard to tell at the moment, but I think it's some of both. My view is a bit more balanced in sense that probably a bit more, it's a balance between supply and demand, but it's clearly, we've clearly got to watch that story very carefully as it evolves. So the activity story is the first one, and the uncertainty. And and I'm sure we'll also come on, there's quite a lot of uncertainty about some of the numbers as well, frankly. Second thing is that, as we've highlighted...
Any particular, obviously we've talked about the labour force.
Yes, I think the other thing I would add, very briefly, because you may want to come back to it, is one of the things we saw last year, we've had an increase in the size, in the population as estimated. Some of which has come through into the labour force and some of which is yet to come through but will do in terms of how the ONS built it in. So when you look at last year, put simply, we've got a bigger population, but we've got the same output and activity. Now, the only way you can sort of square those two things sort of arithmetically is productivity was weaker. And in fact, last year we had negative productivity growth on the year. That's very unusual in a year when we didn't have a recession, actually. So now that would support a weaker supply side story, but it sort of leaves you wondering what's really going on here, actually. There is, happy if you want to come back to this one later, I'll just flag that there's also a question about public sector productivity and exactly what's going on there. Because the numbers are quite striking, but again, how much is it real, how much is it measurement, what's it times? Measuring output in the public sector is hard, statistically. So that's an activity story. As we highlighted, we do expect, and I'll begin to see, a pickup in inflation. Now, just to be clear, it's nothing like what we saw a few years ago. It's all of the reasons for the increase are due to a combination, really, of energy prices. Again, can come back to that if you like, particularly gas. Some stuff on food, where there's some particular shocks seem to be going on, and then administered prices, so water, bus fares, VAT on private schools, those sorts of things. Again, the reason I say that is they're not telling you much about the underlying sort of state of the economy. But the question we had to address was, well, is the old one, is this going to have second round effects or not? Now, my view is at the moment, I would say less likely, and that's a sort of contextual point, really, that set against a weakening pattern of the economy, probably less likely. However, since some of it is in energy and food, those are the two things that when you ask people what shapes their perceptions of inflation, those two things, because we all consume them most frequently, they do have quite a big impact. So we have to watch that. And secondly, of course, you've got the sort of the hangover effect from the last shock with people saying, inflation's going up again, is it? So we have to watch that carefully. The third one is, and obviously we may come back to this, is obviously how the national insurance change is going to feed through. And then the fourth one is obviously the state of the world at large, where we may come back to that as well.
We're going to come into that.
You put all those four together, I mean, that's a lot of uncertainty. So I'm very much, as Alan said, two-sided risks here, and my sort of two-sided risks have increased, so that bears out Alan's point about uncertainty.
Thank you. Dr. Pill.
Thank you very much. So quite a lot has been said already.
We always tell you, so you don't have to repeat it all again.
But I haven't been here for a while because of the election, so it's my first time with this group. So if it's okay, I would quite like to start with a slightly bigger picture view and a bit echo things you've heard from Meccan and the Governor. I do think it's important to recognise that the process of trend disinflation following the very large pandemic and invasion-induced inflationary shocks has continued over quite a long period now. A big part of the fall in headline inflation we've seen from its peak above 11% down to levels which are closer to, but unfortunately still not at, our 2% target, owes to the dissipation and in some cases the reversal of those external shocks that originally drove inflation up. But I also think it's crucial that we recognize that this process does have monetary policy at its center. I think there's two aspects to that. We've got a monetary policy framework that's established price stability as its objective. It's expressed a clear quantitative expression of what that means in the form of the 2% inflation target, and it's given the MPC independence to pursue that target. And I think that's proved to be very important. I think it's also been important that the MPC itself has established in the course of 2022 a restrictive stance for monetary policy to bear down on inflationary pressures, as Megan described. And taken together, these two features have contained the second round effects that threatened and have helped maintain an anchoring of longer term inflation expectations at rates that are consistent with our 2% target. And that's helped prevent the more lasting and more costly deviation from price stability that had followed previous energy price shocks like we saw in the 1970s. That's a topic that we've discussed on previous occasions in this committee. Now, I think, of course, it's the case that that disinflationary process is proved quite prolonged and it's proved occasionally bumpy, and we are again seeing some upward pressure on headline inflation, as others have mentioned. We hope in the short term coming from further volatility in energy prices given by the uncertain environment and external events, and I'm sure we'll discuss these later, so I won't dwell on them right now. Other than to note that they are a reminder that we do need to remain vigilant to new shocks and disturbances that might threaten our path back to the re-establishment of price stability. So then I'll just quickly turn to the recent decision. So from my perspective, it's that continued progress with disinflation towards the 2% inflation target that's created scope for the MPC to reduce the restrictiveness of monetary policy and thereby to cut bank rate a further 25 basis points at the February meeting. And as you've said, that's a decision which I supported and I voted for. But equally important to recognise that the success that we've achieved in this disinflation process thus far does not mean that it is complete. So I think there continue to be echo effects from the large pandemic and invasion-induced inflationary shocks, and they haven't yet totally disappeared. And that's reflected in the persistently elevated rate of underlying domestic inflationary pressures that we're seeing. That's illustrated in the continued strength of services price inflation and pay growth, among other indicators. And I think that's consistent with what Megan said about concerns about weakness on the supply side of economy, suggesting that there is less slack in the economy and more resource pressure in the economy than perhaps some indicators, including perhaps the base case in the monetary policy report, might suggest. So in my view, there is more work to do to squeeze those domestic underlying inflationary pressures out of the system. That entails maintaining some restrictiveness in the monetary policy stance, and that points against both larger and more rapid cuts in bank rate at this point. And that's the basis for why I favoured a cautious and gradual approach to the withdrawal of monetary policy restrictiveness. That's been the case really for the last year. I spoke of this in the summer of last year, and I've supported communication in that direction following the February MPC meeting. I think there's quite a lot of consistency and continuity in that approach. So looking forward, my assessment is that further progress with disinflation would permit further withdrawal of monetary policy restrictiveness and further reductions in bank rate over the rest of this year. But the magnitude and pace of bank rate cuts has to depend on how the risks around that disinflationary path evolve. So on the one side, and I agree with the point that there are two-sided risks, on the one side, weaker demand would ease resource pressures and permit a somewhat steeper path of bank rate reduction, but continued weakness in productivity growth or wider disruptions to the supply side of the economy that perpetuate and intensify this nominal persistence that we're seeing in price developments, cost developments, and wage developments. I think that would likely sustain this underlying domestic inflationary pressure in a manner that would require a slower removal of monetary policy restriction. And that's the framework within which I'm organising my thinking. Just touching on the cases, so I first talked about the cases back in July last year, so I haven't had the opportunity to talk about them here. It's interesting, when I first talked about them, I focused mainly on now what we call case 2 and case 3. I think that reflects where the bulk of my perspective
Central and
is.
hawkish.
I would say that I haven't personally changed my own kind of view of the probabilities, which have been tilted that way for the bulk of this period. And I sort of see the data that we've seen over the last 6 to 9 months, not so much as a surprise, but more a support of that view I've maintained.
That's really interesting. I mean, it's hard to summarise for of you, such eloquent economists, but we did note, and I think it was reflected in what you say, that I mean the word uncertain, the mentions of uncertain in the monetary policy report have interestingly risen from 30 in August, 43 in November, and 62 in February. And I think you're all nodding. Yeah, I think from what you said, that is what's wrapped around.
We haven't counted them, but that seems fair enough.
But wrapped around the decisions. And obviously you've been clear, Dr. Hill mentioned it, that the 2% target is still in place. So I'm going to come to Lola McAvoy on that issue.
Thank you, Dame Meg, and hello everyone. Nice to see you again, and welcome, Dr. Pill. Just to go back on the 2% point, so can you tell us a little bit more about your views on the 2% target? Are we still on track? And what's your broader view on having an arbitrary target and how it's improving the disinflation?
So in terms of the character of our target, I think there's two parts to that. First, why have a target and make it a very specific number? So I think there are lots of benefits in terms of transparency, supporting the clarity of our communication with having a specific index identified and a specific number that we associate with price stability. I think that has helped over the many years, including in my involvement with the MPC and in this committee, with our communication. It helps to hold us accountable, I think. So I do think that's important. Of course, our ability to meet that target on a continuous basis is compromised by all these uncertainties and shocks that we face. So I think it needs to be interpreted both on the MPC side and on your side, and indeed more widely in an intelligent way, recognising the uncertainties we face, recognising the lags in our policy transmission process, all of which make kind of month-to-month, let alone day-to-day, stabilisation of inflation at 2% pretty much impossible. So that kind of medium-term, forward-looking orientation, I think, remains extremely important. I did recognise that you said it was a bit arbitrary, and I think you're right to if you're pointing out there the number 2% or the specific choice of the CPI headline index rather than other, there is an element of arbitrariness in that, although I do think maintaining a consistent approach through time helps to bolster both the communication and credibility of those targets. So I would be, it's not my job as a member of the MPC, it's the job of the Treasury and the government to set the target, but nonetheless I think those are important features. And crucially, going back to what I said earlier, I think having this target has been an important element through this quite challenging period we've had over recent years in helping longer term inflation expectations in financial markets amongst households in firms remain well anchored. It has given a clear guidance of what we're trying to do. I think we have committed and delivered on moving in that direction, and we're making progress with that, as I've said. And I think that stabilization of longer-term expectations on the basis of the target is one of the key differences between what has happened through the course of this external shock episode relative to that which we've discussed on previous occasions in the 1970s and early 1980s, which, as I also said a moment ago, turned out to be much more prolonged in terms of its departure from price stability and much more costly to arrest. In terms of what progress we're making, I think, as you know, in the spring of last year, we did get mechanically back to 2%. I think at the time, many of us on the committee did say, don't be lulled into a false sense of security, because just as there were upward impulses to headline inflation coming from the very strong energy prices, the quite rapid fall of energy prices, albeit not back to where they started, but nonetheless a fall, did contribute negatively to the construction of the inflation measure we target. And that would drop out, and that's what we have actually seen over recent quarters and months. So that short-term volatility is beyond our control, and we need to look through it. Several of us have made this point.
Yeah, so,
I suppose the only other thing that I wanted to pick up on that, so you've said that it's helped mitigate this time with the external shock episode. Do you think having the 2% target as we navigate uncertain times will help with investor confidence?
Well, I very much think that. So I do think our framework is based on a view of the world, which fortunately for me is a view of the world I strongly share, which is monetary policy makes its best contribution by stabilizing prices, providing a credible, forward-looking view that macroeconomic stability centered on achieving the inflation target will persist. And it's by taking out the sort of unnecessary uncertainties, the uncertainty about policy or uncertainty about what the path of inflation, therefore interest rates, both short-term interest rates and longer-term interest rates would be, that we're creating an environment that all those long-term decisions, be they decisions by firms about investment or about individuals about buying houses or education, all these longer-term decisions force you to think about, well, how much is it going to cost me to borrow? What is the economic stability going to be like in 5, 10, 15 years' time? And I think we're providing the anchor that says, yes, it's difficult to take out all these things we're facing in the world now. There is a residual uncertainty we can't take away. But what we can take away is uncertainty about where inflation is going to be at that type of horizon. And that's the biggest contribution we are and can and are making.
Thank you very much, Ms McAvoy. John Grady, MP.
Thank you very much, Dame Meg. If I may start with Ms Green, because you wrote a very interesting paper or gave a very interesting speech at the IOD a few weeks ago about trade and tariffs. So this week the President of the United States has imposed tariffs on Canada and Mexico and additional tariffs on Chinese imports, and there's discussion about a 25% tariff on EU goods. How would you explain the impacts on this to a family of non-economists in my seat of Glasgow? What would you say to them would be the 4 or 5 key potential impacts on their lives of these tariffs?
Sure. So I would start off by saying how uncertain all of this is. We've seen things that have been announced that have been delayed or haven't happened. We don't know how anybody will respond to this. So there's a ton of uncertainty that you have to approach this topic with. And then I would think through the different channels through which tariffs might affect the UK economy. And there are a number of them, and they work in different directions, depending on how other countries respond to them. But I would start off by looking at export substitutions. So if there are tariffs on the UK, for example, then UK goods are relatively more expensive than domestically produced goods by the country imposing tariffs. So people might look for alternatives and stay away from UK goods. That would put downward pressure on demand for UK goods, and so would put downward pressure on GDP and on inflation. That said, there might be a bunch of trade diversion as well. So countries that used to sell into the market that's imposing tariffs might not be able to do so profitably anymore. So they might look for other markets for their goods and might have to discount their goods a bit in order to find these new markets. That would put downward pressure on inflation for the UK. The impact on GDP actually isn't clear. If things are cheaper, then consumers might buy more. But at the same time, UK domestic producers might have a harder time competing with those imported products. So that might be a wash on the GDP side. Then you have to look at exchange rates. And to my mind, this is probably the most important channel and also the most uncertain, unfortunately. So, for example, if there were tariffs, unilateral tariffs by a country, by the US, let's say, on the UK, economic theory suggests that the dollar should appreciate relative to the pound. That might be mitigated by the fact that lots of trade is already invoiced in US dollars. But in any case, if that were to happen, that would put upward pressure on UK inflation and growth. If there were retaliation, however, that should put downward pressure on the US dollar. And the opposite would happen. So you would see downward pressure on UK growth and inflation. So like I said, this is a really important channel. Because the dollar is the reserve currency, it's unclear what would happen. We saw tariffs imposed yesterday, for example, unilaterally, and the dollar actually depreciated relative to the country's currencies that it imposed tariffs on. So this is highly uncertain. And then there are just a few other factors I would think about. One, if you have trade fragmentation generally, you could have the reordering of supply chains. We saw during COVID what that does to growth and GDP. It pushes down on growth, pushes up on inflation. You also have, as a result of trade fragmentation, less kind of knowledge sharing and competition, so that should push down on potential growth. All else equal, that would be inflationary. So there are all these different factors that you have to consider. What I tried to do in my speech was to use a model that I borrowed from the ECB to kind of net them out. And ultimately, it seems likely that the implications for growth are fairly clear. It seems like tariffs would push down on growth. The implications for inflation, which of course is what we're interested in primarily, are much less clear. Net, if you think that exchange rates behave as the theory suggests, then ultimately I think that should push down on inflation, but that's a key uncertainty.
Now, the struggle we all face here is we're trying to look into the future, and none of us are perfect at that. But would my layman's reading of Table 1 in the Bank of England MPC report at the section on the potential effect of tariffs, box C, simply be right that is ultimately the balance of risks are that we don't know what it will do to inflation, but this outbreak of tariffs and the potential for a trade war will lead to lower economic activity in the shorter and the longer run, and less money in the pockets of my constituents in Glasgow as a result. Is that where the balance of risks lie, would you say, Ms. Green?
Yeah, so accepting there's a ton of uncertainty around this, and the choreography is everything. It does seem like ultimately there are more things that push down on activity for the UK than would push up, and the implications for inflation are much less clear.
And as a quick fire round, because I don't want to get into trouble, Professor Taylor, would you agree with my reading of the situation that the downside risks for money in the pockets of Glasgow constituents are higher than the upside risks?
I don't think it's just true for your constituents. I think it's true for people around the country and around the world. So I think the governor has also emphasised this, that it's much clearer to try to understand the effects of tariffs on activity and on our well-being and on our output and our wages than it is to understand on the directionally on inflation, because that depends on many more factors. So I think, in theory, are there certain circumstances where tariffs can make you better off? Yeah, but they're very limited. Like, you're a large country with some monopolistic market power kind of situation. That, of course, doesn't apply to the UK, really. So in that sense, if there are just frictions being imposed by other countries, to the extent that we're caught up in that, it is going to, reduce our opportunity to use trade. We're a country that trades a lot. Trade is, in a sense, another form of technology. You put goods in, called exports, and some of the goods come out, called imports, and that reflects comparative advantage, and it makes us better off in various ways. If you put sand in those wheels, then we're going to be worse off on some margin.
And a question for the governor. Against this uncertainty, if the US imposed tariffs on the UK directly, what would be your three biggest concerns?
Well, I think you'd have to see that in the context of the whole world, by the way. So I very strongly agree with my colleagues on the effects of this. Look, I would say to your constituents, trade supports growth. Openness supports the spread of innovation, it supports the spread of ideas. Glasgow became a great city in the 19th century on the back of trade and the Industrial Revolution. You spend a lot more time in Glasgow than I do, but
you're always welcome to come.
So I'm very
He's buttering you up, I think, Mr.
But look, and Alan, by the way, Alan's written on this. Alan is an expert. He's written on this stuff. But you go around Glasgow, you see the evidence, you see the buildings, that this led to. So trade supports growth. Now, you're right, as Alan said, and Megan said, that we had the experience, obviously, in recent years of the threat to world security, the breaking up of supply chains, and it's perfectly reasonable to say, doesn't that cause us to reassess this sort of just-in-time world trade economy? My view, however, is that doesn't take away the benefits of trade and diversification. It means we have to sort of, in a sense, take that into account. And the final point I would make is this, and what does the UK do? I think the key point we make is that the place to solve these problems is in multilateral fora, where the UK and others, I was in South Africa at the G7 and the G20 last week with the Chancellor. That's a point I made very strongly. If we're going to solve these problems, if we're going to solve the fact, there is a genuine point about balances in the world economy. China has to answer the question, why is domestic demand so weak in China? And the counterpart to that is a very large current account surplus. Germany has the same issue, although in the last 24 hours Germany has done something quite radical, and we may come on to that actually in terms of the impact it's had today on markets. And the US has to answer the question, yes, you've got a current account deficit, you've also got a very big fiscal deficit, and you're financing that current account by external capital. Alan's written a book on this subject, so I defer to him. The place, if you want to, if you think the world economy is somehow out of balance, the place to address those balances is in a multilateral forum, not by bilateral action.
And you gave an interesting speech on this at King's College in Cambridge a few months ago, so we might as well turn to that. Now, trade disputes are ultimately litigated at the WTA, which is a global institution. Well,
increasingly less so.
And less so, you're quite right there. And two others are the IMF and the World Bank. There's been some discussion about withdrawal of the US from the IMF and the World Bank. How damaging would you see that to the UK?
That would be a very damaging thing for the world. I really hope, and I have, the new US Treasury Secretary has said that he believes in multilateralism, and I, strongly, welcome that. One of the most, I think I said in the speech in Cambridge, the world economy has changed a lot since Bretton Woods in 1944, but the most lasting contribution that Bretton Woods has made is actually the creation of the IMF and the World Bank and the multilateral institutions. Now, it is true to say that Bretton Woods was designed in a world where obviously it was designed during the Second World War, but it was designed in a world where the US was actually the surplus economy. The UK sterling was the reserve currency, and And a lot of the tension, you always read these books about the tension in Bretton Woods between Keynes and Harry White, who was the US leader, led the US side, and it was about how to balance the world economy. But the reason I say that is that, from the from the early 1970s, or from the 70s onwards, the US changed from being the surplus economy to being a deficit economy. The Bretton Woods system actually, it was designed asymmetrically, actually by the US, so that the adjustment occurs in the deficit economies, not the surplus economies. But the US then, ironically, has become the deficit economy. So, there's a perfectly reasonable question, although it has been addressed many times without coming up with an answer. Well, do you need to think about how this multilateral system works, given that change? But what is essential is that we don't abandon the multilateralism. That's really essential.
So in summary, you would say that we need to make sure that we keep, Martin Wolf's words, mediation internationally between the grasshoppers and the ants, is his famous essay.
That's very eloquent way that Martin's put it.
Yeah.
As ever.
And in your view, is this, with your kind of historical perspective, Governor, is this a passing storm, what we have going on at the minute, or do you think it's reflective of much greater turbulence to come?
Well, Alan said earlier, what are we going to end up calling this episode and how big is it going to be? I mean, it is a big episode, actually. It really is a big episode. I think it's a very, there is a major shift going on there in terms of certainly, obviously, in the US. So we have to take it very seriously. We have to address it, and we have to be prepared to address it. And I welcome what the government's doing on that front. So I think we do have to be very much, we have to dig in at this point and say, how do we address these issues satisfactorily? We can't ignore them, frankly, at that point, because otherwise, the risks, as I think all of us have said, and the risks to the UK situation, to UK growth. Megan's right, I think, to make the point that the impact on inflation could be ambiguous, but the risks to the UK economy and to indeed the world economy are substantial at that point.
And that means the risks to people in England and Wales and Scotland and Northern Ireland having less money in their pockets ultimately.
Well, yes, I mean that's right. We have to take well, this is what we're here for. Is we serve the people, and we have to take it very seriously.
I think that's enough from me, Dame Meg. But
thank you very much for now, Mr. Grady. Ewan Yang MP.
Thank you, Chair. Dr. Pill, I appreciate the comments you and your panellists have made on the uncertainty facing the future trade tariffs and trade deals that are on the table. I just want to ask a really specific question, which is, in the event of the threatened steel and aluminium tariffs launching into effect next week, what is the kind of game plan that you and your team of economists have right now to monitor that situation and the potential feed through to inflation in the UK?
Well, I think as has been said, and I think as is reflected in the box in the NPR that's been referred to, I mean, we would need to work our way through the specifics of all of this. So, I mean, there are many of my colleagues are examining the various options here. I think the crucial element, which was the one emphasised by Megan, is that we have to see this through the lens of the system as a whole, not just through the lens of what any bilateral relationship may or may not be. And indeed, our bilateral relationship in that area with the US is modest, but in a multilateral context where we are importing from other parts of the world, how they respond to developments on one side of the Atlantic versus the other, or indeed across the whole global economy into Asia, this becomes the sort of key question. And I think that does get to the importance of understanding things not just through their direct effects, but their overall effects. And in particular, for example, as Megan has said, if we were to see trade diversion, so countries that are unable or no longer competitive in exporting to certain parts of the world because those parts of the world have imposed tariffs on their specific goods, would that lead to a diversion into other markets, possibly including the UK market? And that's the sort of uncertainty that I think would influence the short-term outlook for inflation through this route. Of course, those goods are important inputs into many parts of the economy, and so that would have ripple effects. But what I would emphasize, and actually goes back very much to what's been said into the previous question, is those short-term ambiguities about what happens to inflation. It's also true that, like, fundamentally here, all these disruptions are disruptions to the efficient sort of allocation of production and information sharing and capital across the world. And those types of things are what are going to undermine productivity growth And productivity growth is the most important driver of the supply side of the economy, as Meg and I referred to earlier, and also to the living standards that we all enjoy.
You mentioned measures that you're already taking. Can you name some of those specific measures, for example, to pick up on the effects of trade diversion and so on? That have you changed any methodology of evidence gathering? Are there specific measures that you're taking?
I wouldn't say there are specific measures. I mean, we are collecting information. We are always looking at this information very closely. We look very closely, as a general rule, at developments in import prices by sector, and we trace the impact.
You're not changing any modelling at this point?
We haven't changed modelling at this point, no. I think that's fair.
Thank you. Dr. Stevenson.
Thank you very much, Chair. Governor, I want to ask you some questions around monetary policy transmission, the decisions you guys are making in the Monetary Policy Committee, and specifically its interaction with the APF and its current reserve policy. I think you spoke about this a bit before, but I do want to get your views on this a bit more clearly. I suppose, just say for the room, indeed those watching, that at the moment the Bank of England, rather commercial banks hold reserves and the Bank of England remunerates those at the base rate. So when you cut the base rate to 4.5, then that's the reserve and that's the transmission mechanism. What's your view on, if you like, paying the policy rate on all the reserves, its impact on monetary policy transmission, but specifically around this time when you have the APF as well operating?
Well, I think paying bank rate on reserves is the simplest and most efficient way to anchor the short end of the curve. I mean, if you ask the question, when we decide in the MPC what bank rate is, what do we actually do? Yeah. Well, what we do is to, as you just said, is to change or not the rate we pay on our reserve accounts. That's the thing we do, and everything else sort of follows on, as it were. It's a sort of follow through from that. So it's the anchor, if you like, of the very short end of the interest rate curve. And then the monetary transmission mechanism follows. So it is the most efficient way of doing it in that sense, in my view. And I think it works. It's a system that works efficiently. Now, that's the answer to the first part of your question. So you mentioned the APF, which of course is the in a sense is the QE/QT sort of piece of the picture. That's of course separate in terms of the rate we pay on reserves. The thing I would say there, I mean, stop me if I'm interpreting the question wrongly.
Clarify if that's helpful. Is it helpful if I clarify?
If you like, yes.
Yeah. So I suppose my concern is that there is at least two mechanisms by which paying the interest rate on reserves fully is actually damaging the monetary policy transmission mechanism. So the first of those is that on the one hand you raise interest rates as the MPC and that gets paid out on all reserves. Commercial banks are receiving that interest rate, but now they're receiving, if you like, a windfall payment that they weren't expecting. So on the one hand you're raising interest rates, which are supposed to reduce the money supply, and on the other hand commercial banks are receiving more payments they're expecting, increasing their liquidity position. So we've seen, for example, the big four banks' profitability up from 45 billion, up from 25 billion, almost doubled. I think Sir Paul Tucker has it at 42 billion interest payments as part of the APM. So they're working in two different directions, and that's my concern. So on the one hand, the efficiency in the reserves, but on the other hand, this particular moment.
Could I say two things on that? I mean, I've quite often been asked in the past at this committee about the way in which our interest rate changes pass through, particularly into the interest that depositors earn on their accounts. Well, that's all part of the same system, because I go back to a speech. I made a speech at Loughborough University just over a year ago, where I tried to set this out. The banks essentially have to target, they target what's called their net interest margin, because they have to. I mean, they have to earn at least the cost of their capital, and a big part of that is the net interest margin. So that sort of neutrality on the reserve accounts, in other words, we pay them the bank rate, but we expect them to pay out on the other side of it. No, they don't pay the whole. I know the rates do differ, but the point is, if we didn't pay them that, you would see that coming through into deposit rates, because they do have to earn a net interest margin, which reflects their cost of capital.
I get that. That's not quite what I'm getting at, Governor. What I'm saying is that the banks have got a better liquidity position they're expecting. In fact, they've had an unexpected windfall payment, because in 2021 they're expecting interest rates to be 1%. What they've then seen on the other side of it is all of a sudden these reserves that they hold all of a sudden pay 4.5%. So they, if you like, are receiving a lot more money each time you raise
we
the
also
interest
expect
rate.
them, if you think about their balance sheets, the reserve accounts that they hold with us are an asset for them. It's a liability for us, asset for them. They, on the other side of their balance sheet, they have customer deposits, for instance. But when we raise the interest rate, the bank rate, their customers expect to earn a higher return on their deposits.
No,
so you can't just see it as a windfall for the banks in that sense.
No, but it's only a windfall because of the APF, right? Because the reserve payment, the difference in bond payments, that's why it's becoming a windfall for them, right? So you're paying out this money to them. They're seeing their liquidity position expand. But this isn't just me, right? So my question really is about what the Bank of England has done around the monetary policy transmission mechanism. Have you made, in the Bank of England, an empirical assessment by which, if you like, this mechanism by which you're improving liquidity or the asset equity position of banks through the reserve payments and is having on monetary supply, have you made an impact which is damaging or indeed impacting monetary policy?
I think the APF is quite separate, if you don't mind me saying so, in this sense. So we do spend a lot of time studying the monetary transmission mechanism. Our staff spend a lot of time on it because it's crucial to understanding, as you said, monetary policy. Because Hugh talked about the restrictiveness of monetary policy and the restrictiveness of our current stance on monetary policy. Well, a very important way which we assess that is through the monetary transmission mechanism. Is how is it working? So we do spend a lot of time on that. The other thing I would say is that, can I just say, these reserve accounts are there for two purposes. One is monetary stability, the other is financial stability. So we also have to be very careful about the financial stability position, because going back to the pre-financial crisis period, I'm afraid the error that was made in that period was that we had a stock of reserves which was much too low from a financial stability point of view. So we do run a system which maintains a stock of reserves which is consistent with both monetary policy and financial stability.
I mean, I agree with maintaining the stock of reserves. I think it's a question about where we are specifically at the moment, and the specific question I had was around the empirical assessment, because it isn't just me. Look, I've at least 2 CPR papers talked about this damaging effect, and their empirical assessment is that actually by not having some tiering of reserves, that at this point in time, because of the reserve payments going the other side, because banks are seeing more payments and lending more out, that actually you are having a situation where it is damaging the monetary policy transmission mechanism. So my question is, has the Bank of England made any assessment of that or empirically done so? Or is there any plan to do so in the future?
Can I suggest this? We spend a lot of time on the monetary transmission mechanism, but I'd be happy to go back. We'll look at those 2 papers, and I'm happy to write to you.
Thank you very much, Mr. Governor. We appreciate that. Dame Harriet Orban, MP.
Thank you very much, Chair. And my questions are for Dr. Pill. In terms of the 12 recommendations from the Bernanke review, could you just update the committee on how many of those recommendations you've already brought into your decision making, how many are ongoing, and are any of them proving to be impossible to implement?
A lot of work has been started and is being conducted in the aftermath of the report to implement those recommendations, which, as you say, have all been accepted. What I would say, and indeed I've said in some of the public communication I did last year, I think it is important to recognise that the strategy we have is a little bit like an iceberg. There is a lot going on beneath the water level, which is not visible to the outside. And I think probably the fruits of the efforts that are going on there will only become visible in the course of this year.
That's the opportunity you have now to tell us what's going on at the bottom of this iceberg.
Well, the reason I say that is a lot of what's going on is probably the necessary foundational activities before the things that perhaps are more of interest to this committee can be done. So that is about setting up teams to address some of these things. It is about improving our data and IT systems to be able to introduce new modelling frameworks and represent more effectively the output of those modelling frameworks, both internally and externally. And of course, that's a natural precursor to improving the decision-making process along the lines that Professor Bernanke suggested, and then ultimately leading to how we might change our communication of policy. So there's sort of a natural sequencing here, where moving one part of that is both necessary before you can move on subsequent parts of that chain, but also is very interconnected with subsequent parts of that chain. So I think there is quite a lot of preparatory and organizational work that is taking place, which is, shall I say, less glamorous and perhaps of less interest to you, but is extremely important to ensure the success of the overall project.
So have any of the recommendations become part of your way of working? I mean, you referred to the scenarios earlier, and I thought that they might be linked to the Bernanke review. Well,
I think it is certainly true. And for example, when I spoke last July, as I said earlier, when we began to introduce this notion of cases that came up earlier, I think those were introduced a little bit in the spirit of the scenarios Professor Bernanke had pointed to. I think it's also fair to say that they were introduced a little bit in the mode of experimentation rather than this is the answer to which the essay question that Professor Bernanke posed us. And I think that is in the spirit of how I would see quite a few of the things that have happened, for example, in the way the monetary policy statement has been written. It's shorter. That was one of the Bernanke recommendations. It focuses less on the central forecast published. It's more a narrative discussion of where the economy stands. So I think we have made progress in implementation, but I would say that it's probably important to emphasize that I wouldn't want any of the innovations that we've made to be seen as a definitive answer to one of the recommendations. I think we should see it in the whole rather than
when can we expect the recommendations to have been adopted by the bank?
I think that is a progressive process. So I don't think there will be a day where we will say we are going to introduce 5 of the 12 recommendations today in a way that we have not done in the past. So the work plan that has been set out is a work plan that envisages what is called in the bank an agile approach, so an approach where there is some